Yo, assim, shoot. Shoot. Oh, wow. I think in the position, yeah. Wait. We zoom on it. I zoom on it. I many carry forward. Okay. But we are starting, yeah? Where? I see ubere sababa. See ubere sababa. I don't know. See ubere sababa. Bora.
Yupera nipisia nayo mwetu.
Ai. Si ubere sababa. Si mzwani kuranja.
Si ubesa ya?
Tuiza direction desi yana. Kufanya ngani zoni mingi.
Tuiza ma direction sana. I don't know. Okay, guys. My name is Ishma Mateo, studying Bachelor of Internal Auditing, and I am here with Group 1 with my colleagues here. First of all, let me allow them to introduce themselves.
My name is Benjamin.
My name is Hakusebo, studying business administration.
This is Kitwai Jerry. Kitwai Jerry, majoring business administration.
Okay, thanks. So, James Mulinda, boys and girls. This is Group 1 and we are presenting on the topic of fringe benefit tax. To begin with, fringe benefit. The term fringe benefit simply means that it is an asset, service, or any kind of benefit rather than money that is given to the employees by the employer. Meaning to say the employers give some benefits to their employees. Fringe benefit tax is imposed on the fringe benefits that are given to the employers. So these fringe benefits are registered to the Commissioner General, and the fringe benefits are registered within 14 days after the fringe benefits have been started provided to the employees. Looking at that, the fringe benefit tax are based on the amount of the fringe benefit, and the fringe benefit that is more than 20,000 per month, it is when the fringe benefit tax it is imposed per monthly. But for annual is 240,000, which means less than that the fringe benefit tax is not imposed on this fringe benefits. Okay. Employers are responsible for the fringe benefit taxes, and sometimes if the fringe benefit is given directly to the employees now are responsible for the fringe benefit taxes. Failing to register fringe benefits, there are some penalties, and this is considered as to be the offense to the under the act of taxation. The fringe benefits tax is charged up to 30% and is 30% just in general. So guys, thank you. Let me give it to my friends.
Um, hello, somebody got the mark. Mina ndiano fulani. Mina ndiawe okay. It's a space. All right. Hello, class.
Hello.
I am here to explain to you the example of fringe benefits. As my fellow friend has said, fringe benefits are like additional bonuses or advantages that are added to an employee regardless his wages or salaries. And here are some of the examples of some fringe benefits. Health insurances. This is one of the most common fringe benefits that we find in companies. And this fringe benefit deals with mental health, dental health, and some other social services. Secondary, retirement plan fringe benefit. This is the type of plan that it is set up for employees to save up some future financials like pension plans and other retirement plans, life and disability plans. These are some fringe benefits. For example, life insurance. It helps employees in times of death events and some illnesses. While disability fringe benefits, the company provide employees with income that helps them when they are ill. Employee assistance programs. These are the programs that help employees to boost their confidence once they are dealing with issues related to their work or personal issues that are affecting their job performances and well-being. Thank you.
Once again, my name is Happy Sogoro.
Just a quick one. How many slides do you have?
There are about 9.
Any solving?
Yeah.
All right. That's where my interest is.
Once again, my name is Happy Sogoro, and I'm going to explain on offenses of non-compliance and penalties with fringe benefits tax regulations. Non-compliances, these are the same as offenses by employers, and they come with penalties. Number one, non-compliance is failure to lodge fringe benefit tax returns. This is whereby an employer fails to pay fringe benefit tax on time, and then it comes with a penalty of interest charge, whereby an employer pays an interest or the money above the fringe benefit tax that was supposed to be paid. Number two, underpayment or non-payment of fringe benefit tax. This is whereby an employer fails to pay the fringe benefit tax or underpays fringe benefit tax, and it comes with a penalty of administrative penalties, whereby they increase the percentages. Like, for example, here in Malawi, I think the fringe benefit percent is 30%. So if there is an underpayment or non-payment of fringe benefit tax, it increase to 75%. Number three, there is false or misleading information. There might be a point whereby an employer provide misleading information or false information to pay lower tax. Lower fringe benefit tax, and then it comes with a penalty of increased tax liabilities, whereby the employer may pay underpayment tax, and then there's criminal penalties which may end up in imprisonment due to dishonest and fraud. Lastly, failure to maintain proper records. Every employer needs to have the records of his or her employees. So if there is a case where an employer does not have proper records of their employees, there might be a penalty of record keeping penalties, where even if the fringe benefit tax is paid, but the employer is charged record keeping penalties. For that, let me let my colleague to continue.
Hi guys. Uh, we are going to look at denomination of tax values.
Sorry, tax?
Tax values, taxable values.
Okay.
In determining taxable values, we are going to look how taxes are charged on properties that employers give to their employees. For example, housing and accommodation. In housing and accommodation, these are shelters or flats that are given to employees by their employers. So on property owned by employer, this is a property that is given to an employee by their employers. 50% of taxable value is charged or determined if the open market value of use of such properties. Open market values, these are estimated amount that are charged on a property or a house. 10% of employee salary where unfurnished furnished housing. 10% is charged if the house provided to the employee by the employer has no furnitures in it. And 12% is charged if the house provided to the employee by the employer has furnitures in it. Property rented by the employer. If the property rented by employer, it is the property that an employer lent for their employee. 10% of employee salary is charged if the house has no furnitures in it, and 12% is charged if the house has furnitures in it. For example, Ishmael is Ishmael is provided with furnished accommodation by Chikoko's Limited Company. The house is rented by employer at 50,000 per month. The employee salary is 960,000 per annum. What is the annual taxable value for the benefit? So here we're going to calculate the annual taxable value for the employee. So to calculate the benefit as given in this example, the house that is provided to Ishmael or accommodation that is provided to Ishmael is a furnished accommodation. So therefore, we are going to calculate 12% of his salary per annum. So to calculate his salary per annum or taxable value, we are going to divide by, since it's annum means 12 months, we are going to divide 960,000.
You can use this one, I think. Mutaona. Ndema funa ndula mpeleni. Ndiye nanusu muzipuzira utazana wanga present modani. Musadeke. Yende difusa
We are going
mafusa.
to divide by 12%.
Can I have a question? Why dividing by 12%? Mutamama yankira my group members. You're there. Those is for the group, right?
We are dividing by 12% because it is a furnished housing. Yeah, per annum.
Can you go to the previous slide?
It is. Because it is the furnished house and the property is provided by the employer. Yeah, which is the Coco company limited, providing the furniture house to Ishmael. So the 12% will apply there.
Can you read after where you've written one, property owned by the employer? The next sentence, Aulia.
50% of the taxable value is determined thereof. The open market value of use, rental of such property, or 10% of the employee's salary where unfurnished housing is provided, or 12% of employee's salary where furnished housing is provided.
So have we compared the two before starting solving?
The two between.
Restart on the 50% and tell me what you understand from that.
Okay.
The members, how do you understand that sentence? What are they writing? What have they written there? Mateo, don't worry, you pay back, don't worry. No, that's how we make you study. And it will be unfortunate kuzakuza la zimene upanga present sizi kuveka takapangeni present takabwerereni. Ndio uzizifusa kuti nthawi yawo izapezeka ili kuti. Mateo, what do you understand from that?
Okay. It's like the taxable income from the free benefit. 50% of it, the 50% of taxable income is determined later of this.
How do you understand that statement? Gertrude, what do you get from that? Where is Kumbo? What do you get from there?
They are trying to say they have the true values there, which is house rent.
So ndifuna nditenge kuma max anga from these, right? Ngarine ndupanga present ndeu ndiuchosera kuma max, right?
50%
salary when the house is directing a house.
No, 50% uyu mesa aba imene undi step fili kumene kufusa salary tikamasapanga agreed yani 50% iyi isakhaya employer azachosa kuyani 600.
Okay, sir.
Judith, what do you get from there? Munakumana choncho kom?
Okay, sir.
Yes, James.
Oh, James,
Yeah,
can you please
help us.
no give us time to finish the problem and then we should explain.
No. Then you are missing me behind.
No,
All right.
explain.
Let me help you. The answer what you're doing, it might be true. But what I wanted, no, what I wanted you to do first, you know, even at how many Mabanga present too, right? They're not getting what they're saying.
Then that's why we say we should solve it and then
How are we going to solve why we don't understand it?
let me solve this.
Timberane. All we need to do is we need to find the taxable value. Timberane. I've already told you, your participation in others' presentation will also help you. Exactly. You don't know how I'm grading you, so you may be surprised with the grade the 5 out of 20. Aunena Woody, Pajama Gonda Jewan. Messi, you're there. Okay, Aunena Woody. Ngari nyumba, titenge ngari with your example, right? Ngari nyumba imene akukhalamo olembedwa ntchito, right? Yapasidwa ndi company, tiyerekeze ngati kunoko, ndekuti nyumba imene azikhala president, inapasidwa ndi company, right? Kuti tikachaje ndalama imene titauchajapo msonkho, right? Akuti 50% of the taxable value is determined the greater of. So it's the greater of these two. The one which is greater, that's where we need to get what? The 50%.
Yeah.
Are you having the same understanding with me?
Yeah.
Remote?
Yeah.
So if you see there, when they say the open market value of use, which is land, right, of the property, or 10% of the employee's salary where unfurnished housing is provided. Let's understand this first, because we're comparing this and this, right?
Yeah.
So to one guy, if you see the house that has been provided is furnished house, right? So the fact that the house is furnished, we are not taking off the 10%. Because 10% would be applied if the house is what? Unfurnished, right? So we need to look at the rent. How much rent is that person paying? How much is the rent for the house from your question? 50,000. So these are annual. How do they pay the fringe benefits?
How do they pay
Yes.
the benefits?
Uh-huh. Annual.
Okay, and no wait, and paternal wait.
The question, your question. Yes. No. No.
What is the?
Annual tax of value.
How much this is per?
Month,
So what is this by 12?
600.
600. Let's go back there. So there is 600 and
960.
960. Let's go up there. Oh, sorry. Janani. Manichera. All right. So the rent is 600, right?
Yeah.
So if we are combining what? Rent, the 12% of employee's salary where furnished house is provided. What was the salary?
960.
What is 12%?
12% of
960.
115,000. 115, 200.
960.
115, 200. 115, 200.
115. 100 what?
115, 200.
So the question says what? This statement, how do you conclude to that now?
Okay. It's like the 115,000 will take
The 150.
the taxable.
Chedwai, are you part of this group?
Yeah.
Why are you not talking?
Okay.
The 115,000 is the 12% of employee salary, while the 600 will be determined by the 50%.
Then the taxable value will be what?
300. The annual tax, there will be 600.
Will be?
600.
You have understood, right?
Yeah.
Sana housing.
Hey, again. Zoom. So the annual rent paid by the employer. Give me a question. Annual rent paid by the employer will be 50,000 times 12 months, which will give us 600,000. Therefore, we are going to determine our annual taxable value from the 600,000, which is 50%. 1 billion.
That is the 50%. This 50%.
50% of the taxable value. So we are going to do the 50% of this 600. Move. which is 300,000. Therefore, our annual taxable value will be 300,000.
Any question?
Kutama ngene question. Mwavaka bina. So na beba. Nothing.
Tapita formula. On the side. Formula. Yeah, formula. 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 Okay. Guys, so I'm going to solve the fringe benefit rates. So this is a different from LAV. So first of all, let me lab. Okay, so F B R. Okay, Kumbo, do you have any idea on our fringe benefit rates or how we calculate? Oh, you don't have an idea. All right. So let me dive in by saying salary, and I didn't mind. Employee benefits, benefits, benefit rates. Salary employee benefit rates. Salary employee benefit rates. Yeah. Salary employee benefit rates. To get it? So on salary benefit rates we have a formula. That one. The formula we have FBR, fringe benefit rates, is equal to total benefit employee divided by annual salary or wage times 100. This is basic formula. There's a lot of general formula that you can approach this question. So now we're going to start to determine the total cost. First of all, determine the total cost. To determine total cost. So what are total cost? Total cost is let's take it in a company like company cars. All right. Okay, so on to determine listen guys. To determine the total cost, we have company cars. Company cars. We have maybe health insurance. We have compensation insurance. So let's try to assume we have 1,616, then we have 500. Let's try to have maybe we are determining the cost. When the cost, yeah? Yeah. Then,
Let's try to use your voice.
all right. So you're going to add up, eh? Yeah. So total cost. Total cost. Try total. 160, 500, 400.
4,100.
Okay, 4,000.
These are 1,600 plus 400. Only 100. So
France. 2 free? Okay. 2 free. Eh? Okay. Now we're going to annual salary. Remember the total. We're done with the total benefits. These are total benefits that will employer pay in the company. Let's take for instance, your employee is provided maybe laptop. So during working hours, you're going to use like for working, but maybe you can also use it for personal purposes, maybe gaming, change. Yeah. So now we're going to annual salary. Annual salary. Annual salary, the money which is our income that in a year. This it contains educational level, yeah, educational level, experience. This is the main annual salary. So now let's take we have 50,000 words. 50,000 words. It means this is the annual salary, right? 50,000. Hi, 50. 50,000. 50. 50,000. So, we are together? Yeah, okay. So we're going to substitute the total cost, yeah? Total cost, annual salary. We're going to divide. If BR is equal to total cost, 300 divided by 50,000. 50,000. Ukabanga?
Times 100. 4.6.
Aha. If BR is equal to 4.6 rate percent. So this is the fringe benefit rate. Don't get confused. According to my data, this is what I get. According to my data, this is what I get.
according to his data, that's what it is.
Maybe if you have a question, or
As a season, okay, so this is what we discussed based on fringe benefits tax led and fringe benefits tax. Remind you, a fringe benefit, it is just like a gain, like a gain that an employee gets from his or her employer. It might be anything, but not money, not direct cash. Or it might be a car or something else, an asset or any service, but not money. So, reaching this time, we thank you for your attention. At last, if maybe you have some questions, you are free to ask. We are here to respond to your questions.
Yes. Sorry? Yes.
We are going to sign, please.
No, it's only one. Just sign below. What's your name? Happy. Happy. You? No? Benjamin. Happy and Benjamin. Okay, fine.
Can you explain some of the rules you put in the life? Okay. Free benefits, of course, free benefits have a lot of importance or like the positive impacts in an organization or to the employees. Free benefits motivates the employees. Let's take for someone who is working like, and he or she has been given a house like free utilities. What the employer will be motivated to work with passion in order to add an advantage of getting more and more benefits. Thank you. Two more questions. Two more questions or you're done?
All right, new group. Second group.
Thank you.
Kaya, nalungguka bang gagatiko basi? Ay, Georgie, it's not okay. Mbona haringa kumbela yini? Ni maseka yini?
Sana bwe.
Sana bwere, ati sana tumize eso. Ndio kundetu pangato. Sampasa Max, nisa valibepo. Kubiga hapa kwa basi. Good morning, everyone. So my name is Yakosa Nguruwe, and my colleagues are
Margaret Shinola, I'm pursuing Bachelor of Science in Procurement and Supply Chain Management.
and you are going to present on value-added tax. So to begin with, value-added tax is the tax levied on the value added to a product at each stage of its production and distribution. So what it simply means is that from every step, from raw materials to the final sale, a tax is added based on what? Its value. So the main aim of value-added tax is to generate revenue. To generate revenue simply means to provide what? Significant income, source of income to the government. And that source of income is used to fund public goods like infrastructure and security. Yeah. So how does value-added tax, VAT, differ from other forms of tax? To begin with, VAT versus sales tax. VAT is a multi-stage taxation, while sales tax is a single-stage taxation. What it simply means here is that VAT taxes, it taxes value-added at each stage of production to goods, and while sales tax, it only taxes the final sale. And VAT versus income tax. VAT is based on consumption, whereas income tax is based on the income. VAT, it's based on, I can say it's levied on goods and services, while income tax is levied on the income and, yeah, on the individual's income or business income. Then we have VAT versus excise tax. VAT is a broad-based, while excise is selective. VAT is levied, or VAT taxes goods and services, while excise tax only taxes specific goods like alcohol, cigarettes, and then we have VAT versus property tax. VAT is based on consumption, while property tax is based on ownership. So VAT is levied on the goods and services, while property tax is levied on real estates and other assets like cars, vehicles, apartments. And we have VAT versus customs duty. Domestic VAT is domestic taxation, while customs duty is international trade taxation. VAT is, VAT taxes products which are domestic. I can say domestic goods and products. Domestic goods and products are products which are within the country, while customs duty taxes products which are imported. Moving on, we have types of VAT system.
Hi, I'll take you through the second part covering the types of VAT and the benefits of VAT system. The first type of VAT system is invoice-based VAT system. This is the most common type of VAT system. Business collect VAT on sales and pay VAT on purchases. So the VAT that is collected from the customer is called the output VAT. And the VAT that is paid to the supplier is called the input VAT. So the difference between the VAT collected from the customer and the VAT paid to the supplier is the net VAT paid to the government. So that is the VAT that the government will collect. The second type of VAT is the standard VAT. So this is the normal tax rate that a government charges on most goods and services in a country. So here in Malawi, our percentage of VAT is 16.5%. So they charge amount of VAT to a certain price. For example, we want to buy bread and the price of bread is 1,000. So they multiply 1,000, multiply by 16.5, divide by 100. The amount that we will have is the amount that will be added to the actual price. For example, like you can also do on your calculators, 16%, I mean 16.5 divided by 100 is 0.165. So 0.165 multiplied by the 1,000, it gives us 165 kwacha. So 165 kwacha is the amount of VAT that is added to the actual price. So now the final price of bread, it will be 1,165 kwacha. And another type of VAT system is destination-based VAT. It varies based on where the goods or services are finally going to. VAT is charged based on the location where the goods or services are consumed, not where they are produced. I'll give an example, like here in Malawi, if a company is selling goods to a customer who is in Zambia, Malawi does not charge VAT. The VAT is charged in Zambia depending on their VAT percentages. So here in Malawi, we don't charge VAT. Then another type is zero rated VAT. This means that certain goods or services are taxed at 0% VAT, but they are still part of the VAT system. The business selling zero goods can claim back the VAT they paid on their inputs. So there are some businesses that they sell zero rated goods. These are goods zero rated goods. These are goods that they do not charge, they charge 0% VAT. Like for example, I'll give an example. You are exporting goods to like another country. No, let me give another one. Some product like buying mangoes, they don't charge VAT on mangoes. Or maybe the small businesses, they don't charge VAT in the small businesses. It depends on the type of a business you are doing. So the business selling zero rated goods can claim the VAT they paid on their input. This means that a business will purchase the raw materials to produce the product. And the business, when purchasing the raw materials, they'll pay VAT. But when the business person selling those goods to the customer, they charge 0% VAT. So the businesses have that mandate to claim back their VAT they paid during the time of what? During the time of purchasing. So they can be refunded back their VAT from the government. I hope you understand. Another type is multiple rate VAT. So multiple rate VAT refers to a system where different VAT rates are applied to different types of goods and services. So instead of just having one standard VAT rate, governments can assign or can impose various rates depending on the nature of the product. In multi-rate VAT, the word multi means many or multiple. So there are, in this type of VAT system, there are different types of VAT system. in this type. So for example, we have the standard rate. I've already explained that the standard rate, there are no more rate tax. So in the standard rate, for example, a business is selling electronic appliances, they charge at least a higher VAT. It depends on the nature of the product. We have also a reduced rate where there is a person selling bread, so they charge at least a reduced rate to that bread. And they also a zero rated where I gave an example of mango, selling mangoes. They doesn't give any, they doesn't give any VAT. In short, they give 0% VAT, but they are still part of the VAT system. The 0% is still part of the VAT system. So I'll also explain the benefits of VAT system. On the benefit of VAT system, we have generate government revenue. So VAT is applied. VAT is a reliable source of income for government since it is applied at every stage of production and sales. As my colleague already said that at every stage of production and sale, they charge VAT. So the government, they are able to raise their revenue through this VAT collection. And this VAT they used to provide public goods and services such as building hospitals, infrastructures, defense, and whatever. The other benefit of VAT system is reduced tax evasion. The word evasion means it's the act of avoiding the tax. It's the act of avoiding the tax. So VAT is harder to avoid because it is collected at every point in the supply chain. As already said that the VAT at every stage of production and sales, the VAT is collected. So it's hard to avoid or to evade the VAT system. Another type is transparency in tax collection. VAT is visible on invoice and receipt. The invoice is the request for document and it include all the VAT details. When we are buying things in a shop, they include all the amount of product we are going to buy. So, and they include also the VAT, and the VAT is shown on the receipt. So some consumers know exactly how much tax they are paying. So it is visible or it is transparent that everyone knows that I'm going to pay this amount of VAT, or in these things that I have purchased have paid this amount of VAT. And the last benefit of VAT system, it encourages fair competition. So since VAT is applied to both domestic and imported goods, they are taxed at the same rate. The domestic goods, these are the locally produced goods that are produced here in our country. And the imported goods, these are foreign goods that are produced outside our country. So the VAT is taxed, the VAT is collected at the same rate, whether it's the locally produced product or whether it's the foreign produced product. Reaching this far, I'll hand over to my colleague. Thank you. Sorry.
Kangari mukumvira ba sabufa bwaki.
I will take you on disadvantages of VAT. VAT is an indirect tax system. So the first disadvantage is that it is not fair and equitable. Since VAT it is paid with both people earning more
and raise income. So, for example, if a person went to a shop and they buy a product, for example, a bread, he or she is paying VAT the same as a person who is earning more money. Secondly, VAT